Hello, wise people. This is the Wise Finances Podcast.
In today's episode, we're discussing the best time to buy stocks in the market. So I was doing research, and those articles that are very baity, like, oh, if you would have bought Amazon in 2002, you could be or be have a millionaire, or if you would have bought Google before you were born in 1973, you could be a billionaire. And it's like those articles just kind of like grinds my gears, because it's like, how does that help me today? How does that help me in the present? That's great that Apple and Google and Amazon are these great corporations and they have great stocks, all this stuff. But how does that help me today as an investor? So it just made me think of like, when when is an actually good time to buy stocks, as someone who is new to investing, who wants to get into the stock market. So it allowed me to think about, just how can I like find that, and how can I discover that. So I actually, there's these theories, and these are common theories that's known within the investing world. So I want to discuss the four types of months and theories behind when is it best to buy stocks. So there is something called, number one, the January effect. So what the January effect is in the month of January, in the first 2 days of the month, you will see that the stock market will rally, and it has an increase in buyers. And this could be because New Year's resolutions, people like want to get into stocks or want to get into investing. So that might be their like New Year's resolution. You also have that people typically rally to buy in January because of something called loss harvesting. So, tax loss harvesting is when investors basically strategize to offset the capital gains, the, their losses, and offset that so they can lower their tax liability. So, pretty much, if any of the positions they had throughout that year lost them lost them any money in their portfolio, essentially what they're doing is they're selling that, and in order to bring down their capital gains that they gain in their total investment. And so then they are less likely, in their tax liability is shrink because of this. So it's a common thing to do this in January, because you kind of wrapped out the year. So from that previous year, so you kind of know, investors know what they can do, engage in tax loss harvesting. So this actual January effect, if data shows, if you look from 1928 to 2018, the S&P 500 index fund has rose 62% of that time. So that means that 56 of 91 times in January, the markets were up in the month of January. So usually, unlike like other calendar effects, this is just this evidence is just hypo- pot, a hypotenuse of the January effect. The January effect actually is triggered to affect more of like the small capital companies. So the small cap companies, so these are your companies that are looking to grow. So the small cap is just usually like the small market capitalization. So a company's value can be anywhere between 300 million to 2 billion. So usually these stocks are a little bit more volatile and riskier than large cap companies, large cap stocks. So this January effect really has a big effect on the growth, right? You're looking at companies that have high growth in this small cap margin. So that's where we see the biggest effect of this increase in the market in January. Another ripple effect because of the January market, it would be two is the Santa Claus rally. So Santa Claus is real, and this is why he is real. So basically, what the Santa Claus rally describes is when you have a situation where the stock market is increasing the last week of December through those first two trading days in January. This usually happens right similar to what explained before, the tax consideration, the tax law. So that's happening. Usually just a general feeling of happiness and optimism on Wall Street. The investments of like holiday bonuses. So companies are like sending out holiday bonuses. People are going out shopping, Christmas. Retail companies are doing very, very well during this time because you have holiday sales, discounts, etc. Um, this is during a heavy time for traveling and vacations. So this just means that the market is definitely a little bit more bullish during this time. So the theories kind of just again go back to like that increase in holiday shopping, just that optimism feel just because of the holiday spirit. um Investors, book, being able to kind of do some more trading and add into their portfolio before they kind of go on vacation, before they might kind of tune down and not more into the stocks or getting into it those last couple of days because they're kind of just maybe set and forgetting as they go to vacation. So this is something just to note that the Santa Claus rally is something um, to understand, and so that it does happen. So it kind of is an effect. It kind of it's the start, and then that's how you get a good January effect because of the Santa Claus rally that happens in the beginning, at the end of the December, in the beginning of the new year. Markets historically tend to crash in this unique month of October. It is known as the October effect, and this traditionally happens because psycho it's more of like a psychological anticipation of knowing that this is a month that in history has had big crashes. So because we know that things in the past have usually crashed in October, uh we kind of see really the effects kind of start happening in the down in September, but October is when it really hits. So in the past, we had the bank panic of 1970. This is when a big rush of people just went to banks, pulled out their money, and within return, there was a banking crash. Then there was a stock crash of 1929, and then they had the Black Monday of 1987. And so all these crashes happened in October. So this because of this psychological effect, it causes some traders to already just blame October for stock market decline, and it may but is a stock market decline in October. This is why it makes it actually a great in time for investors, new investors to come into the market because they're buying on a bargain, right? They're buying in a bull market. They're buying when things are down, things are low. So that's something to take note of when you are thinking about like October. Goes back to again that those three significant days is like now we just anticipate October just not being a good month. So within that, because we know that the market might drop during those times, that's why it's a great opportunity for new buyers, new investors to be able to come in during that day. Uh the so even though the Black Monday 1987 happened, there's actually been bigger single point declines being 9/11 and was because of the World Trade Center attacks, and then also we had in 2008 because the subprime mortgage melt. So those were actually, even though those days did not, those days actually happened in September 2001 and September 2008. There's still just this big fear around the effects of October and the October market crash, even though we've seen worse crashes in September, actually, ironically. So now, if we're thinking about, now we kind of transition to, we kind of know when the kind of sometimes the worst months, which in sign and technically are some of the best months too to become, if you're thinking of a new investor. What's some of the worst days to come in the market? Well, it's called the Monday effect. And what the Monday effect is basically that because companies know the weekends here and people are more relaxed on the weekend, people are not checking the news as much, they usually try to send bad news to release over the weekend. So because of that, and because we know bad news comes out on the weekend, it's going to impact the market on Monday. So usually if you are thinking about a day to begin your investing journey, you would want to do it on Monday. Why? Because you want to get your stocks at a lower price, as a cheaper price. So why not just start on Monday? In return, that would be, if you're thinking on the flip side, uh, when to sell. I don't know. I don't think Monday's the best day to sell because you might be selling at a low. You might be selling at a loss, and that just goes back to the next point of, really, when is there a best day to sell? Well, it was really hard to find that information because I feel like it goes back to, people would know that, right? And people would know, if you said, "Oh, Friday's the worst day," people will know that Friday's the worst, is the or like Friday's the best day to sell. Then that means it would just be overhyped, and then guess what? It's going to be a new day. Then it's going to be Tuesday. Then it's going to be Wednesday. Then it's going to be Thursday. So I couldn't find anything to pinpoint when is the best day to sell. And I also just think back, it goes back to that logic of being a long term investor, right? Being a long term investor, you're in for the good, the bad, the low days, the high days, and you just don't want to sell because you want to keep your money in the market, right? Time is your best friend when we think about the stock market. The time you're in, the younger you are, you get into investment, less money goes further longer, right? So that's why you get to really see the effects of the compound interest you stand. So that's what this episode is going to be focusing on: keeping buying into the market and not selling into the market. So the other big thing is, well, how should you invest? Should you have lump sum, or should you call this thing called dollar cost average? So historically, lump sum is basically, you take a large amount of money and you just dump it into the market. In theory, this is the best method to do, because what you have the timing, right? If you want to start investment on January 1, right? It's better if you knew you had $1,000, to put that $4,000 on January 1, because it's been in the market longer than if you would have put 100, each month or so, right? Because your money has had time to develop and grow in the market, right? And have ride the waves of the highs and the lows, right? So, but in theory, like, if everyone had a lump sum of cash, they would probably already be in the market. They probably would already be invested. Realistically, um, you're trying to develop your wealth, right? You're trying to grow your wealth. So you probably don't have a lump sum to throw out it. And that's where you get the method of the cost averaging. So, yes, dollar cost averaging is just being consistent, keeping whatever monthly, weekly, bi-weekly amount you choose you want to invest in, and keep that up and just keep that pace. So if yours is the 15th, every day of the 15th month, you're going to send $500 to your investment accounts, and then you just do that consistently and just keep that rhythm. So whether the market is high, whether the market is low, you just continue to do it. Um, And this makes sense. Like I said, this makes sense for most people because, right, you don't have that you don't have that the access to have like a lot of cash. So this is just kind of like, regardless of where you're at, you can always be consistent in whatever that amount is, whether it's $50, whether it's 500, $5,000. You're just really being consistent in the market, because you just it's so hard to just time the market, because who knows, you might buy on a really low day and it's good for you, or you might buy on a really high day. It's so hard to like time the market, because everything is so it can change, and it's impacted on like what our government does, what happens in the news, what happens with resources, supplies, our foreign economy, like, our relationships with different countries. So all that so many things impact the stock market. So it's kind of hard to say on this day at this time I'm going to make the most money than opposed to doing it at this day at this time. So just my advice to you is, whatever strategy you have, stick to it, keep to it, be consistent, don't give up, you know, turn, turn your brokerage apps off if you need to when the days are low. Um, just be consistent. Just be consistent. That's what's the matter, and that's when you're going to see the real growth in anything. And that's with the stock market or anything you have that's important to you, that's connected to you. So, if you don't remember anything else from this podcast, remember one thing, and that's to leave a rating and review, because they matter and you are so important to me. And I want to know that you like this podcast. I want to know that you enjoy this information. Show me some love, send a like, write a comment, share with a friend, send it through a text, do what you got to do. Also, contact me on wise finances underscored on Instagram. My DMs are open. I want to hear your questions. I want to hear your thoughts. Ask them, please. I'm here. I'm an open book. And if I don't know, I'll make sure to refer you to someone who does know the answer. So, yeah, so make sure you leave a rating, you leave a review, you know, you download it. I appreciate that. Thank you for taking the time. And hopefully, you just got to learn a little bit about some of these myths and some of these effects of the market. But really, the best time to the best month to buy stocks is today. 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 Right now. Today. That's the best. That's really the best answer. But hopefully, you learned something. And that it concludes this podcast episode.
This is the Wise Finances Podcast.